Welcome to Litigation and Capital.
You're listening to Litigation and Capital with Steven Mirsky, partner at Mirsky Corporate Advisors. Each episode, we'll break down high-stakes legal issues affecting companies like yours, those earning $10 or $100 million a year, so you can turn complexity into leverage and protect what you've built. My name is Kevin Rosenquist, and I am joined by, of course, Steven Mirsky. Steven, great to see you.
Nice to see you. Thank you for having me.
Absolutely. I'm excited to unpack some of this here. We've got lots of great episodes coming down the pipe here. Our first episode is going to be on strategy. We're calling it Swimming with Sharks, Navigating Finance Agreements. So if you're ready to get started, I'm ready to start asking questions.
Let's go.
All right. Okay. So as bank credit windows have tightened, many companies are seeking financing from private lenders. For companies managing aggressive financing or cash flow gaps, how can you tell when a high interest loan crosses the legal line into usury?
Well, the first foundational element of usury is whether it's a loan or a forbearance.
Okay.
And a loan in California is basically anything where you are given money today for a return of some future value. So that's a very broad definition of a loan. And then the second issue is, what's the interest rate? In California, there's a variety of exceptions to usury, but very generally, the interest rate is either 10% or 12%, depending on which law you're looking at. So very simply, if you see an interest rate higher than 10%, you should flag it, right? Is this usurious? Then the next thing is there an exception to usury that this creditor, has? For instance, are they a bank? Are they a credit card company? Is it tied to real estate? These are some things that, the law allows you to get around. But the better question is, how do you know you're dealing with an ethical lender? And how can I be sure that this lender has, my interest at heart to the extent that it does? And for that, you would look at a couple of things. One, I'd ask, are they a licensed lender in the state of California? Have they filed for the registration? And then the other thing I would do is I would look at a very cursory litigation search. How often are they suing their debtors? I've had a case where there was over 2,000 filings against debtors within the last 4 years. So if you annualize that, right, that's at least one case a day. Mm-hmm. So is that someone you want to get in bed with? Probably not.
Mm-hmm. Yeah, that doesn't give you the warm fuzzies, does it?
No. So those are some of the things I'd look at just initially.
Yeah. And what are the types of financing agreements available in the marketplace?
There's a wide variety, right? So you could have just a traditional term loan. You could do equipment lease financing. You could do equipment financing, which is a term loan for the equipment. You could do revolving credit agreement. There's factoring. And then there's the latest, hottest thing to the scene is a merchant cash advance, which really likes to play in this nebulous region of, is it a loan or is it not a loan?
Is that like the buy now, pay later kind of stuff? Is that what you're talking about?
No, a merchant cash advance is something that says, hey, look, I'm buying your future receivables at a discount. So it says, okay, you haven't generated this revenue yet, but I'm buying that future stream of, and you no longer have rights to it. And so even if it never forms, you still need to pay me. Mm-hmm. And so it's a very weird creature of the law that gives rise to a fair amount of abuse by these lenders.
Okay. All right. And how do business owners identify private lenders?
When you're cooking spaghetti and you want to know if the noodle's done, they kind of just throw it on the wall and see what sticks. So typically what they do is they'll
scientific.
It's a very robust process. So typically the stories that I get are, I'll either reach out to my commercial lender and the commercial lender will do a deal with me. Great. Okay, that's best case scenario. Otherwise, I don't know who to reach out to, so I'm going to find a broker. And now the broker is going to plug me into his or her network. And that's where you can get a lot of different characters to come into it. So you could have reputable brokers, irreputable brokers, and the good ones will connect you with banks or private lenders that actually do deals. The other ones will sell your information to other people who will then backdoor each other and sell your information all over the marketplace. And so there's a lot of risk in that where, you could have unknowingly your social security number, your business EIN number, your bank account information all over the internet being sold and traded for.
That's not what you want.
No. So my recommendation would be find someone that you can trust, check their background. Again, make sure that they're licensed. If they're a licensed broker, then they have ethical duties and standards that they have to uphold.
What are some of the best ways to verify whether that lender is reputable?
Whether the lender is reputable, I would first. There's the hard facts and then there's soft facts. What do I mean by that? There's just data that's objective, right? Are they licensed? Do they sue their debtors on a regular basis? Do they have a good brand reputation? And then there's the soft factors, which are like, are these guys knowledgeable? Am I communicating with someone professionally? Are they texting me weird things with typos and misspellings? Like, how do they hold themselves out to be? And if, I'm not saying it's 100% true, but more likely than not, if they are professional and act with a certain sense of decorum, then they're more likely to be reputable than not.
Yeah, it's sort of like, honestly, it's like doing business with anybody, right? It's like doing business. It's like emails that you get. If they're riddled with spelling errors and grammatical errors, you're like, I don't think this is real.
Right. Yeah. And so, those are just the very basic things I would look at. And then I'd look at the agreements. If I get an agreement, let's say I've gotten a term sheet or a proposal and it looks good to me. Now I want to see the agreement. I want to make sure that I'm dealing with the people that are actually going to lend me the money.
Mm-hmm.
I don't want to deal with the intermediaries, right?
Mm-hmm.
And I want to know, that I want to see the paper before I have to sign it. And I don't want it to be in a sense of like, here's a paper, sign now. We're gonna, you need to sign it today, otherwise, we lose our credit approval, right? That's not fair. And
a bit sketchy, if I'm being honest.
Yeah, and it's a high pressure tactic, right?
Right.
And the other thing you need to think about too is when you look at the agreement, what does the agreement itself look like? Forget about what it says, right? You can have a lawyer look at that, but what does it look like? Is it super tiny font and large block paragraphs? If the answer is yes, put a red flag out there, right?
Mm-hmm.
Why do they need to do it that way? Now, having represented lenders, I could say, well, you were doing it this way so that you don't have a 90-page document that you have to sign, right? But the other side of it is, well, I'm hiding terms that you're not likely to see.
Mm-hmm.
And so make sure, you have the lender walk you through the agreement so you get their understanding of what it says, and then fact check it.
It's almost like a kind of in a way, it's sort of like a trust your gut kind of thing, right? If it doesn't feel right, then there's a reason for that.
To a degree, but I would say that, the business owner profile, that like the psychological profile that'll enter into agreements, they're motivated not by the risk, right? They're motivated by, I need cash, I need it now.
Mm-hmm.
How do I get it? And so there's this conflict within the psychology of the borrower where they're saying, I need to get money, I'll make it work, right? Risk be damned. And so, you need to have someone to either internally or externally to the business pump those brakes and make sure that we're entering into a transaction that's good for the benefit, for the benefit of the business, right? That's ideally why you're borrowing money, is so that you can, reduce your capital expenditure and grow.
Are there other red flags that we haven't discussed that you think borrowers should watch out for when connecting with lenders and determining whether to enter a transaction?
One of the things that I am most interested in these days is Connecticut law. So I just put a red flag out there if you see something in Connecticut law. The reason why I say this is that Connecticut has something called a prejudgment remedy waiver, and it's very popular. And what this says is, hey, if you default on an agreement, I can get an attachment of those damages, meaning I can freeze your bank account for all of the money that I'm alleged to be owed without a hearing and without notice.
Oh.
Yeah. And so, I'd say watch out for that. That's a pretty big red flag. But again, without getting into the legalities of it, just make sure you're dealing with the end user, the person that's going to be lending you the money.
Mm-hmm.
Make sure that they're communicating with you in a professional manner through phone and email, preferably not through text. And if they're communicating with you through WhatsApp, just stop talking to
them. Or Signal.
Yeah. And then the other thing too, it's not a hard and fast rule, but this gets into the more litigation components to this. A lot of lenders are very smart, and if you're less reputable, you're going to hide in the contours of the law. What is, legal, but not quite in good faith. And so I'd say if you're dealing with an entity that's an LLC, it's not a deal killer, but just flag it as this could be problematic. If you're dealing with someone that's a corporation, that's better. There's legal duties and other things that are available to it, and other standards that I personally would feel more comfortable. And then if you're dealing with a bank, you're dealing with a national association, and so it's got its own rules and regulations. So I'd say not as a hard and fast rule, but if they're a corporation or a national association, it's likely better than if they're an LLC.
How rampant is fraud in these transactions?
Well, if you're representing creditors, you're going to say rampant. As when I've represented borrowers, there was a transaction where the debtor straight up did not exist, and we lent money to someone that wasn't there. On the other side of it, you have just today, I'm reviewing an agreement where it says that the creditor exists in state A when in fact it does not. And so it depends on the company. Now, if you are a reputable lender, you're likely to be doing a good credit underwriting process, which is where the delay comes in from the borrower side, right? You're going to look at their financial statements. You're going to look at, their business. You're going to get to know the owners. That takes time. Mm-hmm. And so if you're doing the underwriting and the underwriting's solid, you're more likely than not to be a reputable company.
Mm-hmm. And what are the components to a loan, and what is a reputable lender looking for?
Well, the first and foremost, they're looking to get their money back, right? I think that's number one. Mm-hmm. The other thing is they're looking at the story. What is the story of this business? Where in their life cycle are they? What's the use of funds? How is it going to be deployed? And how sure of this bet can I be? And so we're going to look at, who are the owners? Let's take a look at the financial statements. Is it growing? Is it not growing? Are the sales flat? Why are they flat? You're going to really dig into the whys of the business. So a component to a loan, I guess, in terms of legal documentation, you've got a couple of things. The first is you're going to have, depending on what type of financing it is, you're going to have a security agreement, right? You're granting a security interest in this or that. You're going to have a loan agreement, right? And the loan agreement is going to set forth what the terms of the loan are, what the interest rate is, how the interest rate is calculated, what you can do with the use of funds, what can't you do? Are there any other restrictions on the use of proceeds? What are my reporting obligations? What must I provide and on what basis? And then there's the promissory note itself, which is kind of a restatement of certain elements of the sale agreement. It's used as evidence of the debt. And then there's the UCC filing or filings. And then in some cases, there's going to be a corporate guarantee or a personal guarantee, depending on the creditworthiness of the borrower and use of funds, et cetera.
Okay. And what happens if you default on a loan?
So the thing about a loan or even a equipment lease obligation is that you have hell or high water payments. This means you have to make the payment, right? Mm-hmm. And so if you miss the payment, now the creditor can exercise its remedies either under the contract or pursuant to Article 9 of the Uniform Commercial Code, or Article 2A if it's an equipment lease. And so generally speaking, they have a right to accelerate payment. So if you have trouble making, let's say, a $10,000 a month payment, you're sure as heck going to have a hard time paying back $1 million immediately, mm-hmm. right? They have the right to freeze your bank account and foreclose on their security interests, so long as it's in a commercially reasonable manner. Certain companies, depending on how the deal is structured, they can exercise rights and remedies under UCC 9-406, which allows the creditor to send out letters to all of your customers saying, "Hey, don't pay the debtor, pay us instead."
Oh, wow.
And that's a deal killer for a lot of people because that creates reputational risk and it'll freeze
Absolutely.
all your assets. And it's a big deal. And so, the creditor is allowed to act in a commercially reasonable manner to collect its debts. And that includes coming into your building to repossess the equipment that it has a security interest to.
Does the borrower have any defense? Does it depend on the contract?
Yeah, there are defenses that you can raise based on what the contract says, but the law very generally, right, is supportive of the creditor, right? The
Right.
creditor is lending money. The law presupposes that the debtor is going to pay its debt, and so it's very difficult to get out of these agreements if they're written in a legally compliant way.
So really, if you default, like there's not generally not a lot of defense for you. You kind of you got to pay you got to pay it back, right?
Yeah, you got to pay it back, and but let's be practical here. Let's say I'm a bank, and I've loaned money for the purchase of manufacturing equipment. I don't want to repossess the manufacturing equipment.
Right. What are you going to do with it? Yeah.
I'm not in the deal for that. So
Yeah.
can we work out an agreement to get there? And if the answer is yes, great. If the answer is no, then you're going to battle it out. Or worst case scenario, the borrower files bankruptcy. At which point, now we have other issues we have.
Right. Yeah, 'cause you're right. I mean, what is the bank going to do with a giant packing machine or something like that? They don't need that.
It's just going to sell it, but it's not in the business of selling that equipment.
It doesn't want to get in the resale market of.
Yeah, it just wants money. It's
right.
You're selling money.
Right. Well, interesting stuff, Steven. I'm excited to continue to discuss these topics with you throughout future episodes. And thank you all for joining us on Litigation and Capital. To connect with Steven or learn more about how Mirsky Corporate Advisors can support your business, visit MirskyCorporateAdvisors.com. And if you found this episode helpful, don't forget to subscribe, leave a review, and share it with your leadership team. Steven, it was great chatting with you. Thanks so much for your time, and I look forward to the next one.
Thank you, Kevin.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.